Welcome to our financial management course. Today, we'll explore different types of exchange-traded products. Specifically, we'll talk about mutual funds, exchange-traded fund, exchange-traded notes, and exchange-traded commodities. Let's begin. A mutual fund is an investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. Each investor owns shares of the mutual fund, representing a proportional stake in the underlying portfolio. Mutual funds are managed by professional portfolio managers and offer diversification, liquidity, and accessibility for small investors. There are several types of mutual funds. Equity funds invest in stocks. Bond funds invest in government or corporate bonds. Balanced funds mix of stocks and bonds for moderate risk. Money market funds invest in short-term debt for stability and liquidity. Index funds passively track a specific index. What are some advantages of mutual funds? Professional management, diversification, liquidity. What are some disadvantages of mutual funds? Management fees, potential underperformance compared to benchmarks. Next, what is an exchange-traded fund? An ETF, exchange-traded fund, is a fund that tracks an index, commodity, bond, or basket of assets, but trades on a stock exchange like a single stock. ETFs combine the diversification of mutual funds with the tradability of stocks. There are several types of ETFs. Equity ETFs invest in baskets of stocks. Bond ETFs track fixed income securities. Commodity ETFs track commodity prices. Sector ETFs focus on specific industries. International ETFs track foreign markets. What are some advantages of ETFs? Low expense ratios, high liquidity, transparency. What are some disadvantages of ETFs? Brokerage commissions for frequent traders, possible tracking errors. Next, what is an exchange-traded note? An ETN, exchange-traded note, is a debt instrument issued by a bank that tracks the performance of a market index or strategy minus fees. Unlike ETFs, ETNs do not hold underlying assets. They are unsecured debt obligations of the issuer. There are several types of ETNs. Equity index ETNs track equity indexes. Commodity ETNs linked to commodities such as oil or gold. Currency ETNs reflect movements in foreign exchange rates. What are some advantages of ETNs? Access to hard-to-reach markets, tax efficiency, no tracking error. What are some disadvantages of ETNs? Credit risk. Investors rely on the issuer's solvency, not underlying assets. Next, what are exchange-traded commodities? Exchange-traded commodities, ETCs, are securities that track the price of commodities or commodity indices. Unlike ETFs, which are typically diversified, ETCs are usually backed by physical assets like gold or futures contracts. There are several types of ETCs. Single commodity ETCs track one commodity. Multi-commodity ETCs track baskets of commodities. Leveraged and inverse ETCs provide amplified or opposite exposure. What are some advantages of ETCs? Easy access to commodities, liquidity, and transparency. What are some disadvantages of ETCs? High volatility, roll costs, and futures-based ETCs. This concludes our discussion about exchange-traded products. See you at the next lecture.